This time, let's say you don't own any shares of stock yet, but you have your eye on a stock that you really like. There's just one problem. That stock is expensive. So if you were to buy shares, it would require a lot of capital. What you could do instead is you could buy a call option. This would allow you to pay a small premium for the right to buy shares at a later date if perhaps you are correct about the stock and the price goes higher. So let's look at a real example. Stock XYZ is currently trading at $125 per share. To buy 100 shares of the stock, it would cost us $12,500. So instead of putting up $12,500 to buy the stock, let's instead buy the 125 strike call option that has 30 days until it expires. This gives us the right to purchase 100 shares of stock at $125 per share anytime during the next 30 days. Now again, the price we have to pay for this call option will be determined by several factors that you're going to learn about soon. But for now, let's just say we had to pay $500 for this call option. Let's look at two scenarios. In the first scenario, after you buy the call option, the stock goes from 125 up to, let's say, 137. Now, you own the 125 strike call option. What you could do now at this point is exercise your call option. Exercising your option just simply means that you have decided to take advantage of your right to buy stock at a lower price. So in this case, you exercise your 125 strike call option, so you now own 100 shares of stock at 125. You are up 12 points on this stock, and since you own 100 shares of stock, this means you're up $1,200. But remember, you paid $500 for the call option, so your net profit is really only $700. Now you might be thinking, well, if I would have just bought the stock to begin with, I would have made more money. Yes, this is true, but let's quickly look at one more scenario. In this scenario, the stock goes down. It moves down to, let's say, $100 per share. Now remember, you own the 125 strike call option that you bought for $500, and this call option gives you the right to buy stock at $125 per share. But why on earth would anyone want to purchase stock at $125 if the stock is currently at $100? The answer is you wouldn't, and thankfully you don't have to. Let's think back to the definition of a call option. It gives you the right, but not the obligation, to buy stock. So owning this call option doesn't require you to buy stock if you don't want to. And of course, you aren't going to exercise your right to buy stock at $125 if the current market price is cheaper than that. So in this case, you simply lost the premium you paid for the option, which was $500. If you would have bought stock at $125 instead, you would currently be down $2,500. So that's the benefit of buying an option rather than just buying the stock. You can put up much less capital and therefore have much less risk. But in exchange for that, you will have to pay a premium for it. And by the way, you can also trade put options in this way as well. If you buy a put option without already owning shares of stock, then you are simply betting that the stock will go down. Because if you exercise your right to sell stock that you don't own, then you will just end up with a short stock position. So again, if you buy a call, you are betting that the stock is going to go up. And if you buy a put, you are betting that the stock is going to go down.